You're all early. Story Preserver, you're early. Alan, you're early. Hi, Alan. You're early. Doug, back for round 2? I'm glad. I got 5 minutes, though. This is still the pre-party. Anyone want to talk about the market? Nah. Good time to go get. I only got 4 minutes. You know, we start on time. Hey, early is on time and late is late. Yes, I agree. I am on time. I pride myself. Doug Dudak is back. Hey, Doug. You know what? It's actually a good time to ask. Do you guys mind if I start from the beginning? You know, I'm adding on a little bit, doing this in chronological order, but my sense is a lot of people probably miss it. So is there an objection if I start from the beginning? Anyone who might be listening? It's like another 10 minutes. I see the numbers dropping. Maybe that's... Hey, good morning. Hey, Ken, good morning. Thanks for the Twitter love, Ken. Thanks to all of stocks of stock below 50-day moving average. I mean, the market's weak. I read a stat, something effective, that this is the biggest move into a correction, or one of the biggest in like the 20th century. And a lot of stocks are weak. And you know, I mean, I'm not going to say I said anything on TV, because fuck that. But I will say, I think that you know what, you'd rather buy it higher. You know, everyone I was on with TV with this last week said, bargain, bargain, buy it on sale. You don't want it on sale. You don't want a bargain. Does everyone get that? You will. Kumbaya, good morning. You know, and then you say, well, I can stick around for the long term. The market's going to test you. As we'll see, the market will test you. You ready to stick around for 18 years? Two minutes. 9 a.m. on Facebook Live. What's it showing? I tried to do Facebook. Yes. So I'm doing the same presentation on Facebook, or now, as I did on Facebook. But you guys are my real herd. I mean, Facebook is just, it's a fad. That's all 10 a.m. Central. All right, I got a very fancy holder here. Okay. I know what you're saying. I got. All right. All right. I know what you're all saying. But Christmas is coming up, and you can get me a thing at that point. All right. It's 10 o'clock. I'm not welcome. All right. We made it. Let's just get a little bit of this on here. Okay. Hey. Welcome on on YouTube, and welcome on Periscope. What's up? We have a wonderful presentation. We start on time, and I'm delighted that you're with me, and pleased to have you here. I'm presenting my philosophy on investing. I'm starting from the beginning. It's a short, tight presentation, as you know. Hey, Skylar, good morning. And happy you're here. So we'll take it from the top, as you will. Hey, John from Connecticut, good morning. We'll take it from the top, and happy to take questions, I guess, throughout, although kind of maybe try to keep it relevant. All right, so let's do this. Switch over to our friends on YouTube. Thank you for joining us, and our friends on Periscope. This is the raw feed. Really raw. Like it raw here, people, don't we? All right. You know what to get me. Christmas is coming up. All right, that's not so bad, right? Okay. Everybody good, as they say? Okay, we are back in business on Blue Star. Thank you for joining me. Let's get going. Quick disclaimer, this is not part of objectivism. This is not endorsed by. This is not anything really formally to do with objectivism. I'm inspired by objectivism, but this is my own context. This is my own application. So seek out objectivist sources if you really want to learn about objectivism. This is a philosophy for investing. What could philosophy have to do with investing, you're probably saying? To borrow a line from Arnold, what you talking about, Willis? What does one have to do with the other? Well, quickly take you back in time to Thales. Thales was a philosopher way back in the day, and he was made fun of quite a bit. He was made fun of because he lived pretty meagerly, and he was ridiculed by everyone else, except, oh, what does he do? He's just a philosopher. And this is not so dissimilar as what we have today. Oh, what does a philosopher do? They just talk. But Thales understood that you apply your wisdom. You apply it, and he applied it to investing, particularly to the olive market. True story. So previously, when they had said, well, how is the olive harvest going to be? And should we plant more? Should we plant less? They would always just look to the gods. What do the gods say about it? What do the heavens say about it? What does the priests say about it? So they found some mystical reason to explain why the harvest was good or bad. Thales was a scientist. So he charted astronomical trends. He looked at the sun. He charted the weather. He looked at nature. He looked out to predict what he thought was going to be a strong olive harvest. And he became quite wealthy because he had bought the rights to the olive presses at low prices and was able to exploit prices when they went up. Proving that, in fact, philosophy is not useless. It's required for investing. And that's what I'm presenting. That's why you're here. And you've got one. I mean, everyone, in fact, has a philosophy for investing, really, whether you know it or not. You've got one for life, and you've got one for investing. And it can be as simple as, how do you invest? How do you invest? I invest based on fundamentals, right? That's pretty good reason to invest, good fundamentals. Maybe valuation. I don't like to pay too much. I want to buy a cheap stock. Maybe you invest on politics. That's pretty commonplace these days. A Republican is in office, or dividends, right? Always buy stock that has good dividends. All these reasons that people invest. Inflation, gut feeling. They might have these kind of anecdotal sayings. You never go broke taking a profit, buy and hold. Some more kind of the how you invest, but based on, I would say, arbitrary reasons. And, probably the worst is that you might have a guru. You might invest based on what Jonathan Hoenig or Peter Schiff or Goldman Sachs or anyone else says. Similarly, how do you see the market? You know, I mean, do you see the market just as gambling? You know, oh, I'll take a throw. Do you see it as the random walk theory, that stock price is just a random walk? Do you think the market can be cheap or expensive? Do you think that price has nothing to do with reality? Is it divorced from, you know, is there the price, then there's the actual company? Do you think that you should always own certain assets, right? Like, gotta own stocks. You always have to have some gold. You always have to have some Bitcoin or artwork or whatever. I mean, is that how you see the market? I say, get rid of all that. What we're presenting is something radical, something very different. It's bigger than just buy Bitcoin, right? Or bigger than just always buy stocks. It is how to succeed in markets, in this market, in every market, qua market. And it applies to, not just to one asset, it applies to all markets and all assets. So yes, Bitcoin, and I'm happy to talk about Bitcoin if you want, but it applies to investing. It applies to how to invest over a lifetime successfully. And Ayn Rand wrote about this very explicitly, that you have to have a philosophy. And in order to live, man must act. In order to act, he has to have choices. He has to have a code of values. He has to know the world, look around, see his nature, including how he understands the world. He needs a philosophy, and he can't escape it. From the moment you're able to open your eyes and be a rational, conscious being, the only question is are you conscious about it, or do you just kind of flip from one thing to another, you know, based on emotions? And you might say, oh, philosophy sounds kind of hard. This is just the basics. That's the thing that's important about philosophy, is that it's very broad. It's the fundamentals. You need one in life, and you certainly need one in the market. And that's the whole point. If you have a rational philosophy, it'll help you today in this market. It'll help you in every market. And you know what I call mine, objective investing. And without getting too much in the weeds, and I know this is kind of more dense than, you know, how to pyramid and buying the breakout, but this really is the foundation, the 5 branches. Big words: metaphysics, epistemology, ethics, politics, and aesthetics. There's basically the 3 most important. The first 2, we're going to talk about metaphysics today, is the foundation. How do we see, how do we understand what is the market? How do we understand the market? Ethics is how do we act, right? When do you buy? When do you sell? How big a position should be? What kind of stop loss you should have? Politics and aesthetics also important. Talk very briefly about those, but we'll focus on the first 3. And I know all of these are unfamiliar, especially with investing. So I'll go very quickly, and we'll just give a quick one-liner on each, and then get to the meat for today. What the fuck are you talking about with metaphysics? Metaphysics it's the nature of the universe. What is the nature of the market? You know, is the market knowable? Is it comprehensible? Or is it just like that random walk and chaos and, you know, whatever happens? Is it like Casper the Ghost, where just anything can happen out of anywhere? Or is it more like some element of science, where you can have deductions, you can observe trends, you can have some reasonable expectations? So that's metaphysics. Epistemology is Rand defined it as the science devoted to the discovery of the proper methods of acquiring and validating knowledge. Long way of saying, how do we know what's happening in the market? How do we know, out of all the different prices, all the different influences, how do we know what's important? What do we know other than the market exists? I.e., should investors run for the exits, or should you buy the dip? That's something a lot of people are asking right now. Ethics feeds right into that. That means, how do you act? How do you buy and sell in the most beneficent way? You know, when do you go all in? If you ever do you go all in, just as one example. Politics, very briefly, is a question of government and how markets should be organized. I believe that only under laissez-faire capitalism can investors thrive. And aesthetics is what constitutes beauty. How do you invest? I always say ethics is how to invest, and aesthetics is how you invest. So that's something we'll talk about in the future. These are the big three. What is the market? How do you know what's important in the market? How do you act in the market? And there's a wonderful story told about Ayn Rand where she was asked by a book salesman, just give it to me. Give it to me in 1 foot. Can you present your philosophy standing on 1 foot? Rand took up the challenge and she did it. I am not that good, but I will try to, as my Twitter handle says, make a long story short and give it to you very essentialized, very quickly. What is the nature of the market? What is the market? Does anyone want to venture in here? Any periscopes? What is the market? Tell me, what is the market? Is it all those things we talked about? GDP, earnings? No, market is a market of price. That's what the market is. Metaphysically, and we'll talk about this today. Thank you. Thanks, guys. Yes, thank you. What is knowledge? How do we know what's going on in the market? What is important to know in the market? I say it is trend. And how do we act? How do we act in the market? I say we act with logic, and we will talk a lot about that for a long time. Because look at this. I mean, it's just a chaos. I mean, there's just a chaos of prices and information and data, and it's just, how do you make sense of it? How do you make sense of all of this? And Frank Norris, in one of my favorite books, not a very benevolent book, where the dogs, ask me after. Frank Norris talked about it as a whirlpool, just this roaring waters, and it's quiet, and then it thunders on you, and it sucks you in, and then it throws you out, vomits you out. And this is how most people see the market, as this chaos, just totally unable to understand a chaos. And there's no wonder, because without an understanding, without a philosophy, without the tools, you don't know what approaches to take. You don't know how to invest. So that's why you need a philosophy for investing. And that's why you're here, and I'm delighted you are. So our intellectual journey now begins. It begins with metaphysics. It's what is the market? It's the discipline where we try to understand the nature of the universe. And Dr. Peikoff says it very bluntly. It says that, tells people what kind of world do you live in. Is it a real world? Is it a supernatural world? Is it a world with feelings rule? Is it a world where emotions rule? I believe the market's metaphysics is price. When you look out at the market, when you look at any market, what you're looking at is price. It is always observable. It's not right or wrong. It just is. Price is primary, as my other pseudo Twitter nom de plume tries to put forth. The market is a world of price. That's what it is. You don't trade earnings. You don't trade anything else. You trade price. And it's right there. It's right in front of you. But for most people, it's the last thing they look at. But that's the first thing, and really the only thing I believe you should look at. You don't know why XYZ is at 50. You just know it's at 50. And that is your primary concern. Regardless of what you think about it, regardless of what you feel about it, XYZ is at 50. And you can't ignore that. You can't try to pretend it's anything other, because you're seeing it with your own eyes. Perception is a great point of objectivist epistemology, is that your perception, I believe Harry Binswanger talks about this, your perception is never wrong. It's your conception that's wrong. It's your thinking that's wrong. So why XYZ is at 50 isn't important. It just is. It's at 50. Something exists. What is it? It's the price. If there wasn't a price, I'll get to that, agent. I'll get to all these questions. If there was no price, what would we even be talking about? An asset with no price? I mean, there would be nothing to be conscious of if it wasn't a price. And Parmenides said it. Dr. Bekoff taught it to me, and I love it. It's a great line. What is, what is not, and don't give it a moment's worth of thought. Unless it exists in a price, it is arbitrary and it just does not exist. Doesn't exist in our world, maybe in a supernatural world. And let's use a quick case example. Coca-Cola. What is Coca-Cola? Well, they got a big building, you know, that's headquarters, and look at all those revenues and expenses and income. They got a lot of flows of money and all those employees happy, and they're all working hard, and then all the beverages, right? I mean, Coke is all of these different brands worldwide, and they got a CEO, you know, earnings and dividends. You keeping track of this, making sense of it, and the brand. How do you value the brand? And then, of course, there's the stock price, and there's blah blah blah. There's so much to worry about. No. That's it. Price is primary. That is your focus. That's the only way you understand. The only way you understand Coke, the stock, is through Coke, the price. And it's self-sufficient. There's nothing apart from price. If you want to know how Coke stock is doing, there's no other way to look at it except for its price. And it exhausts what we can know about Coke, the stock. And Rand talked about this as the directly perceived or experience. So you don't have to be a genius to see what price is. A is A. And this is what Aristotle expressed as the law of identity, and that's what we count on as investors. We look out at the world, we gain knowledge of the market, and just as in real estate, it's location, location, location. For us, it is price, price, and price. So we're talking about metaphysics, right? We're saying it's price. Is it knowable then? Let me ask you, Periscope. Is price comprehensible? Is the market comprehensible? Is it just a chaos? Anyone? I'll give you a hint. Yes, it is. It is knowable. It is comprehensible. And it's full of facts. It's full of facts. It's an amazing number of facts out there. But they're not all the same. In fact, there's two types of, I agree, John. I agree, commenters, thank you. I'm sorry, I missed those names. But right, you're getting it. You guys are getting it, which is great. But pretty important, there's two types of facts. Look out into the world. You say, well, facts matter, focus on what, there's two types of facts. And Ayn Rand writes about this. Hey, Phoenix, good morning. Hey, Wayne. Rand talks about two different types of facts, the metaphysical and the man-made. And she defines things that are metaphysically given as outside the power of any volition. Good morning, John. Like gravity, right? Gravity, you cannot deny it. It exists however you want it or think about it. Same thing with the rotation of the planets. You can't say, oh, the planet really Earth should really go a little bit more like that. That's what it is. It's not right or wrong, it is. And that has to be accepted. Ayn Rand talks about, you have to accept that the sun comes up in the morning at a certain time. It just can't be changed, it can't be challenged. However, it's the man-made that has to be judged. It has to just never be accepted uncritically. Thank you, John. So let's now bring it to our market context. The metaphysical versus the man-made. Give me some man-made facts of the market, people. Go ahead. Give me some. Call them out. Come on, anyone? Oh, don't make me beg, people. Return on investment. Good, Johnny. Supply, demand, be a little more specific. Bull market, I'm Hoenig. Company names, yes, that's definitely man-made. Yes, earnings, CEO, right, right, exactly, guys, exactly. Interest rates, exactly. Strong buy, exactly. All that stuff is just our man-made understanding. But it's very easy, yes, exactly right. It's very easy to get, because you're thinking, damn, well, they have the new iPhone 10, or boy, Netflix is just killing the hell out of this one or that one, or volatility. So this is all man-made. This exists in our understanding of the market, any market. I mean, you could gold, anything you could apply this to, real estate. Market price is man-made, subject to the choices of man. No, it's not. Market price is metaphysical. It is what it is. There is no arguing with it. You can argue about earnings, you can argue about competition, you can argue about GDP. You can say, oh, the GDP is going to be good or bad and it's going to affect the market this way or that way. That's all man-made. You can't argue with price. You can't tell me that it's anything other than what it is. And that's what makes it primary. It is the metaphysical. Doesn't demand determine? No. And I don't want to get off track, but let me ask you, a stock goes up, John, NZ John. It goes up because of demand? Maybe. It also can go up because of the absence of supply. So we're sitting around scratching our heads saying, wow, did it go up because people were demanding it, or people weren't demanding it or weren't supplying it? And why did it go up? Who cares? It doesn't matter. Price is a natural phenomenon. You have to see it like that. It occurs without our participation. We can't deny it. You can't say, oh, market went up this week, but I think it's just hedge fund buying or just short covering. You can't question it. It's the only way you can learn what's going on. Just looking at the price. Doesn't mean you're always acting on it. I mean, this is, our actions are not infallible. This is not a panacea in the sense of just how this, but the important point is look at the price and not, it is the metaphysically given. Everything else, it's not reality. It really isn't. It's our understanding of the market. And we know all these things are wrong all the time. I mean, our own estimates are wrong. Certainly our estimates on earnings, on customers, and also how the market will react to that. But the price can't be wrong. It just is what it is. You want a juicy case study, people? Do you? Well, do you? Let's just consider for a moment the differences between a stock and buy, sell, or hold, which a lot of people, a lot of people supply and demand. A lot of people depend on, right? Well, it's got a strong buy by Goldman. It's got a strong buy for that one. Let's talk about GE for just a moment. For the last 14, 15, 16, 14 years, is that possibly right? For 14 years, shares of GE are down about 11% over 14 years. And the analysts, right, the man-made analysts were bullish the whole time. They had target prices that were lower than the price for only 2 months out of those 165. So essentially, they were bullish 99% of the time, over which period of time GE dropped 11%. So the lesson is that the analysts are often wrong. We're often wrong. The man-made is these man-made facts, like analyst estimates, are often wrong. But the market is never wrong. Price is what it is, and God hope if you had some kind of an ethical approach to GE, a stop loss of some sort, you would have been able to act. But the point is you have to respect the price so that when it's dropping and it's going against you, you don't say, well, I don't know, the new CEO XYZ. So you're not able to alter it. You just have to analyze and look at the raw data and then think. It's not just passive acceptance of price. You have to think, you have to act. But when people say, this is why the Dow is plunging, doesn't matter. This I think is the point of what many of you were kind of alluding to. We don't know. Can you challenge? Throw it out, and I'll take it if I want. But I want to move on, because this really is it. We don't know why a price is at its present level. We don't know, and it doesn't matter. In fact, it hurts us to know. So, especially weeks like, well, always, but certainly weeks like this, disregard commentators who say, you know, stocks were up because investors bought, or because of good earnings, or because of anything else. Just disregard that. Ignore it. It's a distraction, and it simply misleads you, because it builds in this faulty cause and effect analysis. And, you know, you could easily say worries about interest rates, right? The drop became because we're worried about interest rates. So we start to, well, if we stop worrying about interest rates, maybe the market goes up. You are focusing on man-made fallacy. So disregard. It doesn't matter why. It's subjectivism. And I'm going to talk about that. We'll talk about that in depth, but probably next week for sure. Let's make this point. If no one buys or sells, the price is the price. It would not move. Correct. Just a basic. Let me get back to that. Let's do another case study. Gold. Take gold. I know you take gold. It's a joke I stole from Harry Benzemaker, but take gold. Let's just give some of the reasons of gold's run over 12 years. The man-made reasons, that's the point. Going back to 2001. Why was gold going up? Well, U.S. raids in Afghanistan. That's what boosted gold to $295 an ounce. Okay, so, gee, maybe if the raids stop, gold goes down. Maybe, why were gold futures up in 2001? Because of attacks in Afghanistan. And also, oh yeah, because of the dollar. Why was gold going up still in 2001? Well, certainly it's been 8 weeks since, or it's been a couple weeks since the terrorist attacks. Conflict in the Middle East. Oh, well, here's a different one now. Why is gold up now? Well, because rumors that a major gold producer was canceling its forward sales. That explains it all. A couple years later, well, now gold's up because of jewelry demand. Demand for jewelry sparkles. These are all, are you getting this, right? And look what you're ignoring, but look what we're ignoring. The metaphysical reality. We're just giving it all these arbitrary examples. Well, now gold's up, it's due, I love this confidence. It's certainly due to demand from China and India, a weak dollar, global terrorism. At some point, they're just tossing everything in there. You know, and here's a novel one. It increased because of all these reasons. Well, Peter's, you know, oh, we have oil. So now gold is up because oil's up. So you're getting this? These are all these man-made reasons. And by the time you get to 2008, 2009, you start to actually have a real good example. Because, wow, now gold is gold because of all this economic crisis, bailouts of Fannie and Freddie. But even after that, well, now gold is up because of the price of cocoa, or because worries about sovereign debt, or because of safe haven, or because Libya, or finally, because of the presidential election. So these are all man-made facts. Think about that. Over 12 years, that bull market was attributed to everything. Everything from 9/11, remember the color-coded terrorism things? It's blue, it's green, it's orange. Hurricane Katrina, that was a reason. All these other factors. And they would have been distractions to you, because what mattered was not why gold was rising, but that gold was rising. And that with that goes obviously a lot of other ancillary markets as well, gold stocks, etc. Focus on the metaphysically given. And if I can quote myself here, I think it's a pretty good line. It's like working for the mob. You know, don't ask too many questions about
the reasons. Ask a lot of questions about the metaphysics, like gold is going up. What about gold stocks? What about which gold stocks? What size? So ask a lot of questions about metaphysics, but the man-made questions are a distraction. Perfect example. I mean, if you were only willing to invest in gold when the man-made reasons became very logical, you would have waited probably till Obama, at least, right? I mean, fears about Obama spending and stimulus. I mean, that was a good reason to invest in gold, but you waited, you watched it go up 200% over that period of time. By the time the New York Times said, well, there's a global gold frenzy, the man-made facts started making sense, a huge move had already been made. And this I think, turns a very common market adage on its head. Have you guys heard this? Everyone's heard this, right? Buy the rumor, sell the fact. There's some wisdom to it, but I think it's interpreted the wrong way. Usually you say buy the rumor, meaning, buy a rumor that something's going to happen and then sell the fact once it goes out. For me, the rumor is the fact. The prices are the metaphysical facts. So that is the fact. It's not a rumor. Price itself is the fact. The man-made stuff is old news. I used to joke that research is something you read when you're sitting on the cam. It's just, it's just old news. It doesn't mean anything when it comes to trying to make money. But at every stage, we circle back to reality, which is our perceptual metaphysical observation. You want another juicy case study? Well, do you? I think you do. Let's talk about the financial crash of 2008. But I'm going to use a little, I'm going to do a little Doug Hoenig shit here for you, because my belief is that if you were focused on metaphysics, not on man-made, you'd have actually known about the financial crisis in 2008. In 2007. It started in 2007. In fact, this is a chart of, the blue is thrifts and mortgage companies, the orange are home builder stocks, and the gray is diversified banks, relative to the S&P price. So by the middle of 2007, REITs were already underperforming the S&P by 20%. Okay, and 10-15% on thrifts and mortgages and banks. By the end of the year, relative to the S&P, thrifts, mortgage, home builders were already down, 20, 30, 40% relative to the S&P. Yes, you saw it too. It started early, but by that time, people were saying, "Oh, I know, housing bubble," but they were making too much money. Point is, by the time the crisis officially hits, these stocks had already made major moves. And you can see it. I don't believe in Google Trends as a price indicator, but people weren't really talking about financial crisis until late 2008. But to our point, I think certainly my point, you saw it happening. There wasn't articles being written about it. This is where all the articles are written. But you saw it happening, and my God, it gave you a couple months to make some changes. It gave you some perceptual information, some proof. We're always looking for proof. Metaphysics is the proof. You want another juicy case study? Let's talk about Cisco, a name from the past. Hard to imagine it. Cisco was once the hottest stock in the world. I take you back to 2000. You remember, Johnny, so do I. This is from Fortune magazine. A bet on Cisco is a bet on the pure, unadulterated growth of the internet. No matter how you cut it, you've got to own Cisco. How's that for intrinsicist perspective? You've got to own Cisco. Doesn't matter what you think. If you believe in the internet, you've got to own Cisco. And then what happens? Just noticing. And the truth is, this was even after Cisco started to correct. So Cisco topped out in March. This is 2 months after that. Now, just to let you know, there's many second acts. This gentleman is now the editor at Yahoo Finance. So I think I guess he failed up. I don't know. I mean, just beware of this type of intrinsicism. That's the point. Beware of this type of intrinsicism. You've got to own this. Well, the internet did take off, right? I mean, the internet succeeded. And so did Cisco by every man-made indication. Over those 16 years, sales, income, Cisco did well. The company did well. The internet did take off. It exploded. But by 2017, Cisco was still half the price it was, roughly half the price it was in 1999. That's the reason why you have to focus on metaphysics. And you have to ignore what's man-made. The metaphysics, that's what you trade. That's the world you live in. If you're an investor, if you're an analyst, you're a TV guy, you live in the man-made world, blah, 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 blah. If you're an investor, you live in the metaphysical world. Because those man-made stats meant nothing. And in 99, as Cisco's promise, it seemed very ambitious. They weren't making big money back then. Their pipe dream was real. The future did arrive. But the point is, by the time it did, right? By the time the man-made facts came to fruition, the market had moved on. Moved on to faster, newer growing enterprises. And if you're keeping track, you're still waiting. It's 17 years later. You're still waiting. I mean, now 17, I'm just 30 now. So I was barely in high school. But you see how long you can wait for those man-made facts. Let's do another case study. China. China, in the early part of the 21st century, was really the hottest growth story in investing. Emerging markets, yes, but China was seen as really a can't lose. Infrastructure spending all around the Beijing Olympics, that was going to be a huge thing. And I mean, you even notice you're not hearing that about Seoul, South Korea. So this was pretty unique to China. It was an emerging economy, and this was the man-made reason. It's all going to be about the spending infrastructure. You got to own it. Beijing Olympics, big. Well, by the time the Olympics came around, the move really had already been made, or a huge move. The bull move, let's say that, had already been made. And the market now has been 10 years on. It still hasn't recovered. That is the Chinese ETF, which is the benchmark for Chinese stocks. It still hasn't recovered now 10 years on. That's the metaphysical. That's what you have to focus on. So that even if you bought it at the all-time high, even if you were completely wrong, 10% down, 20% down, 30%, you're inducing from reality. You're not just thinking about an Olympics. You're listening to the market itself. You're listening to reality. How about another case study? It seems repetitive, but how many people metaverse man-made right now? Sure, I will. Let me go through this and I'll do it at the end. Think about newspaper stocks. There was a lot of consternation. There really still is about, what's going to be the future of newspapers. Paywall, is it going to be the paywall? Is it going to be advertising? So certainly once the internet started kind of coming into this world, a lot of consternation. These are all man-made facts. They're all man-made issues. The stock prices themselves, the metaphysical reality itself was broadcasting a very clear message. Avoid. Relative to the S&P, over and over, new lows. I mean, these stocks gave no comfort to the bulls at all. New lows after new lows. So people were saying, well, what's the right approach going to be? Paywalls or this? The prices themselves were saying just avoid. Here's another example. Washington Mutual, very similar. Very similar. This was a blue chip. This was one of the most widely held stocks. But for, 8 months, almost a year ahead of the financial crisis, You just couldn't find one higher high. So I always say you can buy the all-time high and afford to be wrong. You never have to worry about buying an all-time high. How many new lows do you have to see before something's wrong? Metaphysically, something's wrong. Of course, by the time the facts came out, the stock had already gotten annihilated and the market had already gotten annihilated. If you're focused on the metaphysical reality, you saw it first. So the point is disregard the man-made. Focus on the metaphysically given. By the time the news is out, market's already moved. Now you're probably saying, all right, if price is primary, how do we interpret these changes in price over time? How do we make sense of it? Well, as John McCain would annoyingly say, well, my friend, that is the role of epistemology, and that is next week. Also next week, same time permitting, an appearance by a Chicago hot dog, an authentic Chicago hot dog. Won't want to be here. Sport Peppers, extra Sport Peppers, they will be here next Saturday. Thank you, Luis. Thank you, Ordell. Thank you about it. Gumbaya. Want to thank these thinkers, these great thinkers and writers who are so responsible for so much of the inspiration and content. Once again, not part of objectivism, but you know where to go to find it. This is just my own interpretation. I do this most Saturdays, and I'm doing it in order now. I'm starting at the beginning and updating it every week, giving you the full Monty, as they say. Mookie and the dog. Mookie and the dog. Well, let me just say, TV. TV is the old shit. TV is dead. Those old things, those hackneyed hotties. That's dressing up in cats like with Ann Coulter. That's dead. This is the web show. Web show? What are you talking about? Web show? Jesus, open your fucking eyes. You're watching the web show right now. It's a live-only experience. Look at the buzz. The buzz is huge. Look at the merchandise, right? Things you're supposed to be buying, but aren't. It's all has a free market theme. Give a kid who's graduating like a Venezuelan Bolivar. Teach him a bit about inflation. Teach him about ideas, why they matter. My film is always out. It's great. It's only $3. You see me as a kid. And in my book, also just out and worth checking out as well. So thank you very much. That only took 43 minutes. And with that, you want signed? Buy it. Buy it and I'll sign it for you. Actually, I have that on my website as an issue for signing. Okay. All right. Let's just make this one. Oh, fuck me. Okay. All right. Hold on. Everyone relax. Everyone relax. Everyone relax. Okay. Everyone relax. All right. Thank you. Excellent. All right. All right. This looks terrible, but fuck me. Hold on. Oh. All right. All right. Why not? Thank you. I saw some questions. And I think there's a way I can actually even get on YouTube to see some of those questions. But let's start on Periscope. I'm delighted to take them. This is low budget. This is very low budget. Start buying some shit, and I'll make some investment. At this point, very low budget. If you don't hear from Jonathan for a month, we know he's buried under a stack of books. This is not even the extent of them. I mean, a lot of these are the trading books. All right, real questions. I'm going to look and see if I can just find any questions on YouTube. The barrel is wide and deep. A lot of these are the trading books. Oh, look at me. I'm hearing myself talking. All right, come on. Any questions? Otherwise, I'm going to go work out. When the economy gets stronger, makes interest rate goes up, says Carl. Who knows? Who knows, Carl? You're focusing on the wrong thing if you're focusing on what the economy does when interest rates go. Can I give you an example of today? Well, I mean, the best example I can give is this idea that the markets go, why is the market going down? Because of worries about interest rates? I mean, how many times have you heard that in the last, yeah, I mean, why is the market going down? Because of worries about interest rates. We've heard that. Showed my package on YouTube, I don't want to say it. But why is the market going down? Because of worries about interest rates. So that's the best example I can give, very plainly. That is a total subjectivist, man-made, arbitrary conception. And the best example I'll give for it is, think about in 2007. Why did they say the market was? Why was the market going down in late 2007? Was it a financial crisis? What did they say? It was a problem with what? What was the problem? Subprime, right? Oh, it's just this problem with housing, but it was subprime. This is just an issue with subprime. That is a perfect example of a man-made fact that fucked you, because you said, oh no, this isn't me, this isn't banks, it's just subprime. Well, who knows? Who knows what this is? I remember being on the set with Charles Payne years ago, before oil began its major decline, and Charles was down 5% from the high, 10% from the high, and Charles is like, aren't you buying this? Do you think this is a dip? No one knows. You don't know whether this is a dip or anything else. Well, so I want to get to Sean's, but someone said, what am I looking at right now? Are we still in a bull market? I mean, I don't see, of course, over what time frame and context, but I'll say this, I'm not putting money into stocks right now. I don't buy dips. I don't believe you should buy dips. Correction, who knows? I just don't think you want to buy a dip. You never know if a dip is a dip or the beginning of something more meaningful. And you have a lot of arrogance, not you, but I think one has a lot of arrogance in buying a dip, because it's like saying, Price is telling me something opposite, but I know better. I'm smarter than the market. I'm smarter than Price. Sean Sean asks, I'm not clear why you consider Price metaphysically given when it's clear the result of a bunch of collective man-made buying and selling decisions, or non-decisions, or not at all. I mean, Sean, that's the whole point. We don't, as investors, now if you want to talk about it as an analyst who's analyzing the economy, that's not the world I live in. I live in the world of investing. I live in the world of trying to make money off buying and selling investments. So in my context, you might be saying, well, let's find out who's making the most money, or let's find out which group is buying or selling stocks. All of that comes down to one piece of information, the metaphysically given piece of information, which is price. So what else is there to consider? Other than the world we live in, and we don't live in a world of bunch of collective individuals. We live in the world of price. Decisions are not coordinated, so it's unknowable. I mean, even if it was coordinated, uncontrollable. I can't tell you how many times if you knew what the data was going to be, you oftentimes wouldn't know what the reaction would be. I mean, how many times have you seen news come out and the market doesn't do what you think it should or what the news would suggest it would? I mean, sometimes it goes up on good news, sometimes it goes down on bad news, quote unquote. So when you're looking at anything other than price, you're deluding yourself. Because if it existed, if it mattered, you see it in the price. Jay Wardell asks, is volume worth considering? I mean, for me, it's secondary. I consider volume an indicator not dissimilar than, for example, like the magazine cover indicator, that it's more of an aesthetic application, and I'll put it this way. I mean, I always say I like stocks that are doing well, but that sound crazy, that are kind of hated. So So oftentimes with those situations, you'll see very low volume because there isn't a lot of public interest. I mean, yes, oftentimes you'll see an explosion of public volume or certain volume at market highs, but it's price. It's got to be secondary to price. 401k under 5,000, anytime around withdrawal taxes. I mean, how you withdraw, it's you got to talk to your kind of tax person about that or whatever. I mean, the thing I will say is that just because you're a certain age doesn't mean you necessarily should be in stocks or bonds or anything else. It's a question of position size. I think that's the big difference. There's a sense of if you're young, you're in stocks. If you're old, you're in I don't know, bonds. But perfect example, what's been a great trade is palladium. I mean, work. That is a, cash doing nothing is a position. When you talk palladium, do you mean ETF? Well, yes. I mean, ideally, you want to be as close to the asset as possible. So, and use the, so for example, yes, when I talk palladium, I would mean the palladium ETF, but other people might interpret it as palladium miners, which I wouldn't. I think you want to kind of be specific. So palladium, I mean the palladium ETF, right? I mean, palladium futures or physical palladium. I mean, that's kind of a little bit more difficult, but yes, palladium ETF. Do I look fat? Shouldn't precious metals generally trend opposite of a true bull bear market? I mean, look at gold. We just gave an example of gold for 12 years, trended up in a bull market and a bear market. I mean, it's a perfect example. In a real trend, which we'll talk about in metaphysics next week, there's a number of different reasons. Gold, it really, I mean, you could say the same thing with the dollar, right? Over gold's bull market, it went up when the dollar was going up and going down. I'm back on YouTube. All right, well, so no, you don't want to think like, well, gold's going up, but it's also a bull market, so I'm going to discount that trade. Those correlations. Do I trade the FTSE? Not really lately, but correlations are not airtight. Venture capital investment objectivity. I mean, I have to say, venture capital is not my area of expertise. I would defer you to a lot of great venture capitalists on that issue. It's just I don't know much about it, unfortunately. Well, should we go play in the snow? I hope this was of value to you. If it was, tell a friend. What about looking where precious metals are used? What are you talking about? That's what you're leaving with? What about looking where they're used? What have I just been talking about for an hour? Do I think the correction is over? I don't see a lot of examples of it. I don't see evidence of it. Even something as benign and kind of ubiquitous as the 52-week high and low list. Still a lot more stocks doing poorly than doing well. That doesn't mean you should go out and dump your book. No, I think that's an ethical decision that's based on your own context and your own situation. But I'm not I don't buy dips. I don't buy weakness. It's like saying, I'm full of the same old examples, but I have to tell them to myself, and I think you probably do as well. You want to bet on a horse. You go to the paddy before they start running around. You could bet on the strong one, neighing and stuff. You can bet on the one with a broken leg and say, well, I hope he turns around in this race. So you'd rather buy it higher. It sounds kind of crazy, right? You'd rather buy it higher. Bitcoin at 11,000, you'd rather buy it at 16, in my opinion. You'd rather buy it at 17. I can't think of any individual stocks, but you'd rather buy it higher because you're buying it for the big move. You're not buying it for a 6 or 7 or 8% jump. You're buying it for a big move. So if you're buying stocks, I think the Dow at 25,000, I think you're buying it for at least a move to 30,000. Hope the pups are okay. Thanks, Alan. I'll just say briefly, Fisco is an older dog, and he's got arthritis, and he's feeling a little quiet. So I'm not subjecting him to this orchestra. Rhodium. Down a couple of days. I mean, it's down a little bit, but I still believe that's in a bull market. I'm also talking my game. Do media and analysts say best and worst market days because of man-made facts? Well, Scholar, they say it because they have nothing else to talk about. That's the whole thing we say, like Dow 25,000. Media waits until there's a big number. Dow 25,000. But for us who are watching price, we've known about that. We saw it coming. But no one makes a big to-do about industrial index hits 36-month high, right? That's not interesting to a media audience. So when you're watching price, you know those headlines before the media does. So yes, media loves markets in turmoil. Just tune it out. Honestly, tune it out as much as you can. Because what ends up happening is you see someone who's supposedly smart and they say, I think the sell-off is just temporary. And then you look at your own position when you're down 25% and you say, well, Abby Joseph Cohen, or I don't know, was it, I don't know these guys. Jim Rogers thinks it's only temporary. So then you say, well, let price be your guide and let your own context be your guide and let your own situation be your guide. This is a question of aesthetics and ethics, but just as an example, let's say you've got 3 stocks, a couple of small little losers and 1 big winner. Maybe you dump some of the losses and try to preserve the winner. Most people's response is to lock in the gains. So, there's ways to deal with it. Is having a mentor help you trade better? I don't think so. I think you have to learn these mistakes on your own, but hopefully you learn them with a good philosophy. If I didn't read a lot of these books, including a lot of objectivism, but also a lot of Jesse Livermore and some of the other books I've cited, I would still be losing money. I would have long but run out of money. I joke, and it's not a joke. It cost me over $1 million to learn all of this. And I'm giving it to you for free. Anything else? Should we table it for next week? What I've learned, investment based on neural knowledge takes the subjectivity out. Yes, I think knowledge. What is knowledge? Knowledge is knowledge. What is the data? What is the data of knowledge? The knowledge is price. That's where it starts. So we did metaphysics. We're done with that. Next week, it's epistemology. Did you take any screenshots? I have a feeling I didn't see any. Get the word out. And thank you for being with me, and have a great